We are having this special chat on ET now with the Chintan Haria, Head of Strategy and Product Development at ICICI Prudential AMC. Today, we are going to chat about the new fund. ICICI Pru AMC is in the process of launching Alpha Low Volatility 30 ETF. Chintan, thanks for your time and welcome to the show. Let's start by understanding the name says Alpha Low Volatility 30. I'm sure this name consists some amount of introduction, but why don't you help our viewers understand what exactly is this fund in terms of details and the way it has been named?
So if we look at over the last 3-4 years, in general, ETFs globally as well as in India have picked up as one of the allocations from various investors into the equity markets. And within that, of course, if we look at it, traditionally, we've had the large cap indices, which have had ETFs. This is our endeavor to add to our bouquet of existing multi-factor or existing smart beta ETFs. And if we see from a perspective of what this brings on the table, this particular product, it is a mix of two factors. First factor is alpha, which we'll explain in detail later. And second factor is low volatility. So what we've done is we've brought in a factor of alpha and low volatility. And this product essentially will consist of 30 stocks chosen on the basis of alpha plus low vol. And from an investor perspective, we believe that this multi-factor strategy would be a good addition to their overall existing equity allocation.
Chintan, also, I'm glad we're starting with ETF. What is also being observed in the market right now, that a whole new breed of investors / traders are entering the market. Perhaps, they're spending a lot of time with technology interface at home, and the urge to understand equity markets better because other asset classes perhaps are not doing that great apart from one odd gold. Can you explain why ETF is actually a great way for first time or new investors to enter the entire multi-year journey of equity investing?
Yeah, so if we look at it globally as well as in India with interest rates coming down, there has been a clear shift in terms of people looking at other alternatives. And within the other alternatives, especially in India, equity has always been a very low allocation. And that continues to be so. But with interest rates coming down, there is an increase happening. Now, within equity, there are choices which people have had in the last many years. We've seen mutual funds also grow on the active management side. And on the passive management side, in the last 3 years, especially since the time the Provident Fund started investing, there's a lot of interest which is coming up. And as part of that, if an investor wants to participate in the markets through the index form or the ETF form, it essentially becomes a good first step to start investing when the entire market, you essentially get the entire market or a set of stocks selected on a certain basis of parameter within the ETF. And the advantage with ETFs is that you get a diversified portfolio of maybe 30 to 50 stocks, depending on which ETF it is, at a limited amount or at a small amount, because the ETF units are traded in multiples of one. So you can actually go on the exchange and buy 1 unit of, say, the Low Vol 30, ICICI Prudential Low Vol 30 ETF or any of the ETFs which are available. And with 1 unit, which could be in the range of 30 rupees, 40 rupees, or even 100 rupees. So it essentially breaks down the entire index and makes it unitized so that investors, even the smallest of investors, can participate in the equity markets through the index route or through the ETF route, as participating through the ETF route, which gives them a diversified portfolio, which is essentially the ETF.
Chintan, also ETFs versus other funds is that the cost of these ETFs are very low, not only the unit cost, but the transaction cost. And if we were to talk about a very long period, say 10 years plus, talk to us and explain for our viewers why this transaction cost is also actually a very big factor for investors when we take into account overall performance 10-year plus kind of a basis.
So I would say that you mentioned about long-term investing. I think in long-term investing, what matters is asset allocation more than either the transaction cost or the cost of the product, etc. So of course, the transaction cost in ETFs would include the underlying ETF cost, which is their underlying expense ratio of the ETF in which you're investing, and of course, the brokerages, etc., which need to be paid when you're buying and selling on the exchange. But I would look at it this way, that these are in the long run, if you buy and hold a small portion as far as the overall potential wealth creation that may happen. So if equity allocation needs to be taken place, there are many alternatives. And within that, if we see, these are low cost ways of actually investing. And the longer you keep, the lower your transaction cost, because you're not buying and selling. Because if you keep buying and selling, then obviously your transaction costs increase to that extent. But if you buy and hold and treat this as an equity allocation for the long term, and in fact, you can keep on accumulating units as you keep on saving money. In the long run, it has a potential to deliver risk-adjusted returns, which may add to an investor's overall portfolio creation.
And we are also seeing that our viewers, be it the new first-time investors, our analysis shows that the non-metros are seeing the maximum addition of new investors across the country. Many of our viewers who are watching this program right now, how would you emphasize on the importance to have a reasonable chunk of their investable surplus in equities in order to really build wealth to achieve financial freedom, say in their in the far out in the future? Because everybody talks about it, but what are the steps requirement, and why it is so important to have reasonable chunk in equities so that compounding can help them?
What is reasonable chunk itself, Ajay, is very different for each individual, because each individual has different risk-taking abilities, different responsibilities, different incomes. So there's no one size fits all, and that's where we believe that as we need good doctors for our health, we need good advisors for investments and our financial health. And to that extent, I think from an India perspective, while a lot of education is going around in terms of what an investor should do in terms of asset allocation and equity allocation, what's most important is that as an investor, you first decide what is your risk-taking ability, how much money can you spare for the long term in terms of equity allocation, because as we've seen in the last 6 months, in fact, equities can be very volatile. We had March, which was a downfall. From March, the upswing has also been quite ferocious. So if we combine these two, it becomes very important that part of allocation, which is for long term, because when you're buying equities, when you're essentially investing in ETFs or index funds or active funds, passive funds, which is essentially equity or even direct equity, it essentially is nothing but you're becoming a part owner in a business. And when you're becoming a part owner in a business, you see businesses going through ups and downs, but in the long run, if the business is good, you end up basically participating in the profits of the business through the market capitalization increase that happens in the business. So I would say that two things are very important. One, the investor must know the risk-taking ability that the investor has in terms of how much risk can he take. And second, in terms of how much of the money the investor can spare, either on a monthly basis or on a lump sum or otherwise, from a longer term perspective. Because the moment we start to speculate and the moment we start to think that, okay, I'll invest today with a gain in mind in the next 6 months, that's where most of us end up making the wrong steps in terms of the markets. You would have seen and you would have spoken to many of your investors as well, that in the month of March, very few of us could actually take the advantage of a market fall and invest. That's because we are not planning enough. I think with good planning, good asset allocation, and a long-term view, equities as an asset class definitely deserves a certain allocation, and you should do it over a period of time, rather than jumping into the markets when the markets are doing well and going out of the markets when the markets are doing badly.
Sure. With this point established now, let's shift focus, Chintan, and talk about the Alpha Low Volatility ETF. Talk to us what went by designing this particular fund and some of the qualities which stand out for this particular fund.
Yeah, so just probably speak about the fund itself, just to make the viewers understand what it is all about. Sure. So the universe of the fund, in other words, since it's an ETF based on an index, the rules and the methodology are very, very clear, and it's straightforward. One, the universe. What will be the universe of stocks that would be taken into account while picking the stocks for the index? It is essentially the top 150 names. So the Nifty 100, which is the 1 to 100 by market cap, and the Nifty Mid Cap 150, which is the 50 stocks in mid cap. So that becomes my universe to start with. After that, once the universe is established, we have two factors like I was earlier mentioning, alpha and low vol. Now, what is alpha? Alpha is essentially those stocks that in the last 12 months have actually done well on a beta adjusted basis. In other words, those winners, if I may use the term, those stocks which have been winners in the last 12 months, they have a 50% weightage in the scoring, and the balance 50% weightage in the scoring is on low volatility. If we see low volatility, it's essentially those stocks which are most stable, the stocks which have been most stable, and 50% weightage will go into those stocks. We sum the two in terms of alpha and low vol scoring, and those 30 names which have the best scores, combined scores of alpha and low vol, are picked up. So these 30 names will be selected, and then their weightages will also be dependent on the scores. So not just the stock selection, but also the weightages of the stocks will be determined by the scores, which is alpha and low vol. And to top it up, as an additional risk measure, what we have done is we've kept 5% weightage cap of a particular stock during the rebalancing period. So the rebalance happens in this particular portfolio every 6 months. And at the end of 6 months, when the rebalance happens, no single stock will have more than 5% weight. So there are enough inbuilt checks and balances, risk measures in place to ensure that you have those stocks which are doing well on an alpha basis, which is essentially bringing the growth, while keeping the stability in mind through the low volatility factor. So growth with stability is what we are trying to achieve in this fund, with a 30 stock portfolio chosen out of the top 150 names in the market, with a single stock cap of 5%.
Sure. Chintan, help us understand what kind of investor did you have in mind when you were designing this particular portfolio? Also, tell us, if I am not wrong, you're trying to create alpha for the investor, but at minus the big volatility, so that there's less heartburn, there's much more peace of mind, and steady kind of return can be generated over the period of time. Is it not?
Sure. So that's true. So from a target audience perspective, I think from the smallest retail investor to the largest institution, they can choose to invest in this fund. I think the core aspect of this is that the investor should believe that, okay, I am getting a particular portfolio set of 30 stocks which has winners, which are rebalanced every 6 months, and there is a inbuilt safety mechanism of ensuring that they are not the most volatile stocks. Because what may happen is, if you have only the winners, but the winners are such that they can be very volatile and they do not have stability, that can affect you, as you rightly mentioned, negatively. So that's where we brought in these two factors. In fact, the whole concept of multi-factor, which is essentially bringing two factors like alpha, low vol, and alpha and low vol together, is to ensure that we do not rely on any one factor which may increase the cyclicality of a product. So we to reduce the cyclicality of the product in order to have better risk-adjusted returns for the investor for the long run, through a very simple mechanism of having the winners with stability. We believe this suits every investor, every investor's equity allocation. This can be a part of that equity allocation, and that's what essentially that's the reason why we're launching this fund at this moment. And the investors can keep accruing or keep accumulating the units on the ETF as and when they have the disposable surpluses. And over a long period of time, this will allow them to participate of the growth of equities.
Chintan, can you also talk about when you were designing this portfolio and the process of making this innovation in your entire suite of scheme which the fund offers? What kind of research went into it? What kind of back testing did you guys do, and how are the results which made your conviction even stronger to go ahead and launch it?
Yeah, so see, if we see as far as launching ETFs is concerned in India, the ETFs may be launched on indices which are from a regulated entity, and so this particular ETF also is part of that. It is in terms of back testing. If you see, there is history of 15 years, and in terms of what's the results of that is that over the last 10 years, if we see, which is calendar year 2010 to 2019, 8 out of the 10 years, the backtesting is showcasing that this ETF has been able to beat the broader market indices. And that's where we believe that it has inherent strengths to basically add on to the overall portfolio of an investor. While we as an AMC have many products within the ETF space, even if you look at just the pure Nifty low vol, then NV20 ETF, those are also there. Those are based on single factor. this is our first endeavor at a multi-factor strategy. And we believe it should work well for the investors in the long run because of bringing these two factors, which we felt the market is ripe right now in terms of enhancing people's understanding. Because till such time as we don't have the products on the shelf, maybe people will not be aware of it. Maybe people will not get a sense and feel of what a multi-factor strategy is all about. So this is also an endeavor to educate investors as to what potentially can be smart beta, and within smart beta, what is multi-strategy factors.
So Chintan, this multi-strategy factor ETF, do you think can be far superior than many of the ETFs which are already there in the market?
So I think each one is own. Different products have different cycles. If an investor is very clear that, for example, I want to invest in a single factor ETF and I like low vol as a factor, then the investor may choose low volatility ETF as one of the products which we have. But then if an investor believes, okay, alpha plus low vol, this is winners, growth plus stability is what fits my risk assessment well, my requirement well, then the investor may go for that. So it's not like one is better than the other. I think it's just giving an investor a choice to select based on which factor suits the investor's requirement the best.
Sure, but of course, this the innovation and the R&D which has gone into the development is that it is bringing both of best of the two worlds together. Chintan, talk to us how the mix of stocks would be, and when you were designing this, what kind of sector exposures were taken, and how all of that would be. If you could just give us some flavor of the composition of this fund.
Sure. So if we look at it as on June 30th, 2020, this portfolio has a large part in consumers and pharma. That's predominantly because probably in the last 1 year, these two sectors have done well. The good part about this product is it has an auto rebalancing mechanism wherein every 6 months, it looks back in the last 1 year and which are the stocks in terms of alpha have done well and which are the stocks, more importantly, which have been stable. So the sectoral allocations have, as we've seen in the last 15 years, they've kept on changing, right? They've kept on changing with sometimes consumer being a sector which has, like, for example, right now it has a higher weightage. Sometimes oil and gas, in fact, also in, I think if I'm not mistaken, some years back, had a higher weight. So between various sectors, it keeps on rotating. But there is no sectoral cap because essentially there are already checks and balances like a single stock cap and low volatile stocks and alpha generators. If we put one more layer, it may actually become counterproductive. So to keep the products simple, there are no sectoral caps. But we've seen in the past history that the sectors keep on changing based on whichever sector is essentially doing well.
That's interesting. So it's very dynamic in nature, and it will not fall in that in kind of a trap, as some say, that our own benchmarks have become 40% weighted only towards one sector, the outlook of which is looking slightly shaken. So anyways, since we're talking about ETF investing and the alpha low vol 30 is in focus, one question which comes into mind in front of every investor, especially the early stage investors and first time investors, is it the right time for me to buy this ETF? The markets seem to have run up a whole lot. I missed the March crash. What would you tell that kind of an investor who may be liking this product because of the safety as well as growth opportunity coming together, the risk adjusted return attractiveness, but is again worried, is this the right time to enter the market?
So I guess, again, I'll go back to that same thing. We firmly believe that asset allocation is the first step. If your asset allocation allows you to invest in equities, then yes, this becomes a good time. No denying the fact that last 3-4 months, the markets have rallied a lot. But if your investment horizon is 3 years, 5 years, 10 years and more, the longer the investment horizon, the better in terms of investing. And also the fact that you must keep space. If tomorrow the markets come down, your asset allocation should then move higher towards equity. So looking at the markets right now, if you believe that, okay, you'll put all your money in equities because the markets are doing well, that's not the right way to do it. But some aspect or some part of your allocation which needs to go to equity, that you can potentially look at this as one of the choices. The ICICI Prudential Alpha Low 30 ETF as one of the potential investment options that you have. And as the market keeps going along, because eventually if you see in the long run, what happens is as the GDP of a country grows, the companies also grow. And when the companies grow, their top line and bottom lines keep growing. And that's how the equity markets eventually grow in the long run. But in the short run, it is the most volatile asset class. And that's where investors need to be patient and more importantly, need to have the right frame of mind in terms of asset allocation and keep their greed and fear and emotions in check while investing in ETFs. So to basically answer your question very simply, it is not for me to decide whether the investor from a timing perspective is good. It's for the investor themselves to decide that, okay, today, based on my wealth, based on my responsibilities, I have space to invest in equities. And within that, I feel this product fits in well. Let me go ahead and start investing bit by bit. Thank you.
Chintan, if I'm a millennial, safely stable in my job, between 30 to 40 years of age, in a regular income via job or maybe some kind of a business, and I feel like starting an SIP in Alpha Low 30 if ICICI Pru with a 20-year kind of a horizon, what is the probability that I would lose money in this proposition in SIP in percentage terms, and what is the probability that I would make 10 to 15% kind of a return on a CAGR basis at the end of 20th year?
So again, predicting returns is something which is next to impossible, but what it has been seen in the past, and if we look at in terms of the growth of any country, as the country grows, so does their equity markets. And if the investment horizon is indeed 20 years, like you've seen, in the past history, at least no 20-year period has essentially had a massive negative return. In fact, 20-year periods generally tend to have positive returns most of the time. I think the number is 100% of the time, if I'm correct. The 20-year returns have been positive because essentially as the economy grows on a compounding basis, at the end of 20 years, because of the sheer power of compounding, which is considered to be the eighth wonder of the world, you end up making better returns in equities. So yes, indeed, if you have a 20-year horizon and if you do it systematically, and like you said in the example, if it's a 30 to 40-year-old, probably leave that legacy with your children as well. It may end up being a good investment at the end of 20 years because of the power of compounding, because of the equities growing in line with the growth of any country and economy.
Right. All right, Chintan, great chatting with you on markets and on the potential of this particular fund, Alpha Low 30. I'm sure a lot of new investors which are joining the industry on a monthly basis and a lot of existing investors who are looking at diversifying into much more smarter ETF products would consider ICICI Alpha Low 30 as a part of their portfolio. Thank you very much for joining us and explaining this offering and coming on ET Now. Thank you very much, Chintan, for your time. Take care. Stay safe. Bye-bye.
Thank you. Stay safe. Thank you, viewers. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.